also say thank you to the church for allowing us gather together here and also share knowledge. And let's say a word of prayer. Our Lord and Father, we say thank you. Thank you for bringing us here. Lord, we pray you teach us yourself today in the mighty name of Jesus. Father, our eyes of understanding you open today in the mighty name of Jesus. And Father, the knowledge, the understanding that we need, you grant unto us in the mighty name of Jesus. And you take charge and you take control in the mighty name of Jesus. In Jesus' name we have prayed. I want to start on a lighter note, and to start, I would likely ask, do we know the new interest rate? Was there a change or was there no change? Yeah. Yeah. And do you know why it was constant? Do you have an idea? And okay, let me start on this note. I'm not an economist. I'm not a financial advisor. I'm not a broker or whatever it is. All I just do is I also try to get knowledge, do a bit of research, also engage a lot of people in terms of getting what I need in terms of information. And why I'm saying that is because we are in a very regulated country, and by virtue of that, if you are not licensed to give advice, you can't give an advice. So what we are doing here is not giving advices. We are all just having a conversation, and conversation is a two-way thing. We share knowledge, we gain knowledge, and we also share or learn from each other's experience. I think is very key. We start on that note. The slide we have used today is the same one we had gone through before, and it's actually starting on showing us the interest rates that we have today, the bond yield, the treasury bill yield. This slide is just giving us a bit of insight into what is happening. Currently, the interest rate is 2.25. That's the Bank of Canada interest rate. Treasury bill rate, I think the rate is like 2.2 or thereabouts, while the bond yield rate is between 2.4 and 2.2. All this slide is just telling us is interest rate is coming down. Treasury bill yield and bond yield is coming down. What that means is investment, whatever there's likely or there's probably no investment you can do now that is giving you the best of returns. That if you keep money whether in GIC, that is very, very common. GIC is a kind of an investment, but they put the money into yield or treasury bill. They just use GIC as an investment platform to gather our fund. But all the investment they do is putting into bond, is putting into treasury bill or whatever it is. So whatever kind of investment we're talking about, all these three things are the one that drives the interest rate on those investments. And because interest rate is coming down, it's infers or government is using this tool of interest rate, bond yield, and the rest of it to drive and to stimulate the economy, because they are trying to make people spend, and they're also trying to make much more money available in the circulation, which is encouraging people to bring out money to do one thing or the other with the money that is available. I think that's why this slide is very, very important to talk about. So I also did a list or a chart of interest rate. This is interest rate from 2020 to 2025. The first part is showing the post-COVID era of interest rate. If you check the rate between 2020 and 2022, that was the lowest interest rate it could ever be. And the lowest interest rate is this, which is 0.50. That was when the economy started recovering after COVID, because COVID had a very, very big impact on all economies around the world. And I don't know the history of Canada so much, but I don't think they have had it that good to have interest rate as low as 0.25, 0.50. It was just like borrowing at no interest. It was just as good as that. But after the economy recovered after COVID and the rest of it, then things started changing. It was going 1.5, 1.5, and the rest and the rest. And it beats my imagination that some people, I also fall into that category too. Some people that did some big things when interest rate came back, I think they were not good to us. Because if you check, interest rate as of July 2023 was 5%. So imagine people that bought houses, done some big things when interest was 0.05, compared to somebody either doing whatever you even do to borrow money and you are paying 0.5%. is just unimaginable. And it is what it is. You can't say because you interest rate is 5.0, you won't do what you have to do. You can wait, your wait can be good. Nobody even knew whether the next rate is even going to be higher than 5%. So it's just done on one that when you are ready to do what you have to do and you have those resources, you just have to do it. So, and why this is also important is if we are now coming from the era of 0.05, it went to the high of 0.5, and eventually came to 2.5, 2.25. That means something is happening. Something is driving that change. And as we said, Canada is a land of information, and the information one has and use is what is useful. If interest rate could change from 0.05 to 5% and now to 2.5, that means if you could take advantage of 2.5, it's good to change. It's good to take that good advantage. It's a golden advantage, if I may say. And what is driving the economy is the fear of the impact of American tariff, and also trying to control the economy with interest rates. That's why the change is really coming down drastically of lately. And by projection, some people say it's going up, some people say it's coming down. At least we have another rate that was done December 10, that was like a few days ago. The rates didn't change. Some people were projecting it might come down again. Eventually it didn't come down, which also means maybe we're also reaching a turning point. And the turning point is whether that 2.5 is still going to be sustained for a few more months before it either goes up again or it comes down a little more. But I know what they are doing is they are kind of looking at what is going to happen with the tariff negotiation and every other thing. And by what everybody sees too, Trump is also holding to that tariff tactics to drive whatever is actually trying to achieve for America and economies tied to America. And because we know we are also an economy tied so much to the US, because the US kind of almost controls the North America continent as a whole. But the long and short of it is, at this 2.25, the next interest rate I think is happening in January or thereabouts. Nobody knows whether it's still going to remain or it's still going to come up. That's the path for that interest rate. So this is also just showing the downward trend. It's just a graphical trend of from 0.50 to 0.25. And these are the rates, the dates they change almost all the interest rates. It's actually a constant date on a yearly basis. The date varies maybe by 1 day or 2 days or thereabout. But at least in a year, like last year, I think they changed it 7 times last year. This year, I think it's done like almost 5 or 6 times already this year. There's no more interest rate announcement this year again. The last one was done on December 10. So the next one, I think, is in January. So at least in a year, they change it like between 5 to 7 times or thereabout annually. That's their trend of interest rate change. This is a pictorial view of the portfolios that we have that interest rate are applicable on. Interest rate is applicable on personal loan. Personal loan is a bucket list of loans, whether it's small loan, whether it's car loan. The key point is a personal loan is a loan that you can refinance as many times as you want it. The terms are not fixed and are not stringent. as much as you have a personal loan, you can do as much thing as you want to do with a personal loan, because they are kind of small loan, medium loan, and the rest of it. But when we move on the part of mortgage is the biggest and the chunkiest part of the loan. Is the one that has the most stringent terms and conditions attached to it. Student loan, it's not really too, student and education loan is not too serious, but it's also a loan that the terms and conditions are also not quite bad, but the deferring of interest payments and repayment of student loan makes student loan very, very convenient. The other loans are credit loan, home equity, and the rest of it. Those other loans, they are like almost a regular credit card loan and the rest of it. They are a small portion of the loan. But the chunk of all the loan available in this economy revolves around mortgage, personal loan, and student loan. Because of the value of mortgage loan has a chunk portion of loan in the economy. Because mortgage is capital intensive, and whether for investment or for personal loan, whether for investment or for personal, almost everybody has a mortgage. Not everybody has, but almost everybody has a mortgage, and the amount involved in mortgage makes mortgage loan a big portion of the loan. The personal loan is smaller because they are loan that varies between personal loan and other loans, which are the line of credit card loans, and the rest of it. So between personal and between personal and other loans, they are the variable loans, which is outside the mortgage. So the three loans, which is personal, mortgage, and other loans, are the three categories of the big loans that we have. But mortgage is just the main part of the loan breakdown. This slide is just included because I want to give us a link to a calculator. There's something called loan interest calculator. That calculator is a calculator that is very, very friendly. It's just one checking it out and putting your loan rate into it. What that calculator does for us is it shows a loan interest to the term and also to the end of amortization. Let me break it down. The term of a loan, every loan has a term. Every loan has an amortization period. Let me break down into pieces. Term of a loan, for example, mortgage is a very, very familiar part of loan. We'll say we can do mortgage fixed of 5 years, fixed of 3 years, and fixed of, I think, 10 years or 7 years or thereabouts. What that means is, in the period of 3, 5, 7 years that you have fixed a mortgage, your interest rate is fixed till the end of that 3 years, 5 years, or 7 years. That means if you have fixed your rate at, let's say, 3.75, till the end of that 3-year term, you pay 3%, 3.75 on the loan balance at any point in time. That's the term of a loan. Amortization of the loan is the whole lifespan of the loan. Mortgage is either 25 years or 30 years. If you are doing 5% payment on the mortgage, it's 25 years automatically. But if you are doing much more than 5%, if you're doing 5%, okay, if you are doing much more, you do 30 years. So if you are doing 5% or thereabout, 25 years is your amortization period. Amortization period. If you are doing more than 5%, your amortization period for mortgage will be 30 years. So amortization period is the whole lifespan of a loan, while term period is the term period that you have fixed the interest rate of the loan. What that enables you to do is, at the end of whether you have done 3 years, 5 years, or 7 years, that means at the end of 3 years, they expect you to come back and renegotiate your interest. If you have done 5 years, 5-year term, that means at the end of 5 years, that is when they expect you to come back to renegotiate your interest. While by amortization period, in an amortization period, that's the whole lifespan of a loan, you can go and renegotiate your interest as at the end of each term. That means every 3 years, you can go and renegotiate your term, your interest rate term. If it's 5 years, you go and renegotiate after each 5 years. If it's 7 years, you go and renegotiate after every 7 years. So that's the essence of a term and amortization. But the beauty of it is, as much as you are entering into, okay, yeah, please go.
Because now, based on what you told us,
Yes, sir.
interest rate is now lower
Yes, sir.
compared to previous years.
Yes, sir. Yes, sir.
Now, can somebody approach and ask for, thank you, and ask for, instead for the lifespan, can somebody lock in 2.5% for the whole lifespan, not going back to renegotiate?
Yeah. I've also been curious about that question, but I think in Canada it's not possible. By what information here can be very subjective and relative, and depends on who you are talking to, where you are talking to them, and from the position you are also talking to them. Like in this our country, myself and you can go to a lender to borrow money, and your rates will be different than my rates. And it's based on just 3 or 4 categories. My interest score, 1. My repayment terms, 2. And also my loan standing in terms of what I've done in either history of loan with the bank or history of relative lenders. Those are all they put into criteria. So the 2 of us can go walk up to a lender and they give us 2 different rates for the same amount of loan that we are borrowing. It's very possible. It's very, very possible. I will give you a quick example. I wanted to buy a car when I came into Regina, and I went to Taylor to buy that car. It was just very, very recent that I came in here, and I was just starting my job then. I needed that car because I don't have any. We had a car, but we was my wife in Saskatoon then, and they said, "You have not collected your salary, but we can give you a car, but at a certain terms and condition." I bought that car at 9% in November 2022. And right in the same office that I sat, a guy came to buy a car, and he bought that car at 5%. So not that I wore a wrong clothes, or not that my face was not shining well, but it was just the exposure of the bank and the dealership to the 2 of us. I don't have a good credit history at that point. I've not also demonstrated that I'm faithful and I can keep up paying with my loan as I should do. But the other guy, I never knew him from Adam. I don't know whether he has a relationship with the dealership, but I was just shocked that we are negotiating the same. We are not buying the same car anyway. He's buying another kind of car. I was buying another one. So he was even buying a brand new car, a brand 100% brand new car kind of a thing. And mine had almost 10,000 kilometers on it. And he was getting 5%. And I bought mine 9%. So back to your question. By what I've heard, I learned in US you can lock down the repayments, the terms of a mortgage, the rate of a mortgage for the whole lifespan of the mortgage. But I don't think it's possible. I've not heard, or I don't know whether it's possible in Canada. I've also asked that question once too. Yeah, I know. That's why I say you can go to lender, and lenders will give different terms on the same kind of loan. And they will just look at you, look at your capacity, look at so many things around you, and they can work out anything with you. If they think you can either do it, or you are capable, or you are a good customer to them to work out things. They can be that very subjective. So it's actually your call. And your call based on the interest rate. If you are doing 3 years, your rate will be different than somebody locking 5 years. So if you are doing 3 years, you can't get the same rate with somebody doing 5 years. It's not possible. Which one will be higher is most likely the 5 years. Because anybody doing 3 years, they expect you to come back after 3 years to renegotiate again. But anybody doing 5 years, that means if he doesn't come to break his mortgage before 5 years, that means he's locked into 5 years. What, like the idea of you banking something and going to sleep, bank like that kind of stability. If I do 5 years, that means for 5 years, we can afford not to see each other for the next 5 years. And everybody will be happy as much as you are paying your loan. And if you are doing 3 years, that means at every 3 years, you come back to me again, you come and renegotiate. So you are giving me, your account is much more stressful than somebody that has 5 years. So I will offer somebody doing 5 years with me a better rate than somebody doing 3 years with me. So that's the idea. Okay.
Thank you. I want to find out if you lock in, assuming 3 years, and in the course of the 3 years, the interest rate drops to maybe you lock in maybe around 3.75,
Yes.
and in the course of a particular year, the interest rate drops to probably be like 2.55. Can you go to your bank and say, no, I want this new drop in interest to reflect in the calculation of the interest rate, or it's not possible until you wait for that since you've locked in?
Yes, sir. That is the summary of our conversation, but we'll give you a sneak peek into it. If you lock in 3 years, Ramaya, you can break your 3 years anytime. Loan is not cast in stone, but the unfortunate part is we all sign loan or mortgage or personal loan and we don't go back to look at the contract. It's very, very unfortunate, and things don't happen like that here. Because if you are maybe for loan, if you don't do it for any other thing but for loan, there are two very important things in every contract you have signed for a loan. Number one is called the terms and condition of the loan. And in the terms and condition of the loan, the most important clause you should look for in that clause of the loan is your repayment, your interest rates, your interest penalty, and what's the last thing that I think I noted down? And maybe breaking or penalty or restructuring payment or something. So where that is if you early payoff and prepayment, early payoff and prepayment. Where those things are very important is so that if you decide that you have much money and you want to put in more money than you are doing, you can use that clause to change the terms of your loan. That's number one. Number two, if you're saying there's a new interest rate change and you want to take advantage of that, you can activate that clause to know what you can do with it. If you also want to change the structure of your payment, you can also use that clause to change the structure of your payment. It's very, very important to look at all those clauses in any if not for any other contract, but for loan contract. Those are the most important clause in a loan contract.
So that's a follow-up question. So if interest rate falls maybe like 5 times in a year, you have the right to go to your...
You can break your contract 5 times. If you have breaking of contract in your loan.
Okay.
If you have breaking of contract in you, I don't think there's any contract that should not have breaking of contract because it's not cast in stone.
Okay.
So if you have that clause, the result of you doing that is paying a penalty. Yeah. The result of, even if you have signed a 100-year loan, if you want to break it 100 times, the result of you breaking it each time is you paying a penalty. And those penalties differs by lender. Some people had gone to a lender that says, if you are breaking your mortgage or your loan contract, you pay an interest in advance of 6 months as a penalty for breaking it. So that means if you choose to be breaking every six months, you're paying penalty every 6 months. Some have also said, if you want to break your contract, you pay penalty of 3 months. Let me also dive into this. In the category of lenders, there are band A lenders and band B lenders. All the 5 big banks in Canada, they are the band A lenders. Their terms of breaking a loan is the most stringent. That's why people run away from those banks when you want to do some transactions. Interestingly, those banks know, but they try to offer people maybe not too good rate, but something to also give them a catch. But if you are doing loan or doing whatever with the 5 tops bank, their terms and conditions is the most stringent. Because the band B bank go to the band A bank to borrow money. So whether you borrow directly from them or you use a band B lender to borrow from them, they really don't care so much. But band B lenders are very, very flexible in their terms and conditions. Why? Because they try to gain customer or get attraction and compete so much with each other, because there are a lot of band B lenders. Their names are not familiar banks, they are not popular, but people look for them where they need to get them, because their terms and conditions are very, very attractive and flexible. 1,000 in one of them. First National, Strife, Manulife is okay. They are not in the tier 5 tier bank, but they are small. Yes, there are a lot of small. Even some names that you've never heard it before. And why they do is they work on, because some of them borrow money from the 5 big bank. So all they need to do is just making their product or their loan marketing attractive. That's why they offer flexible terms and conditions. Can we move on? Yeah. So this is the calculator is actually on the Government of Canada site. The link for the calculator is the one right there. We can copy the link and use somewhere. So, but I just intentionally include, and that calculator can be used for any type of loan. The beauty of it is it gives you a full pictorial interest that you pay to the end of term and also to the end of amortization. That's the beauty of that calculator. There are so many loan calculators, but I just found this one very, very, because it's from the Government of Canada itself, and is also very friendly and attractive. And we'll have confidence that this is from the government itself. So it's a calculator that can be used for any type of loan. So I did a short example just for conversation use. Somebody borrowed a loan for 500,000. Let's assume there is a mortgage. Its interest is 5%, and is going to pay. You remember the clause I said, amortization period. So that means the loan will be fully repaid by the end of 25 years. And he pays once monthly. I didn't want to make it complex, because some pay bi-weekly, some pay full month, but I just don't want to make it too complex. That's why I chose it will pay his month 12 times in a year. And the end of term now, term is 5 years. That means at every 5 years is when they expect him to come back and renegotiate his term. So that means in 25 years, he can go back and negotiate his time just 5 times at every 5 years. So why I was particular about that calculator is that calculator will show me the interest rate to the end of term. If he borrows 500,000 for 5 years, for 25. That means at the end of interest payment, at the end of 5 years, he will pay 117,000 on 500,000. Compulsorily, he will repay that 500,000. But the full interest he will pay, if he pays the loan monthly to the end of 5 years, he will pay 117,000. On the other trick, if he didn't do anything on that loan and is faithful to it to the end of 25 years, at the end of 25 years, the total interest he will pay is 372,000. So 500,000 he had borrowed, paying 372,000 interest on it, effectively he has paid 872,000. By the end of term, if he had borrowed 5 years, he's paying faithfully monthly, and he has paid for 5 years, that's 60 months. By the end of 60 months, end of 5 years, he had paid 117 fully. That means 500,000 for just 5 years. No, he has not fully paid his loan fully. It's just he has paid for just 5 years. At the end of 5 years, the interest he has paid is 517. And by the end of 5 years, principal, because monthly you pay part of your principal and you pay part of your interest. Repayment monthly is broken between principal and interest. So the full amount he has paid, principal and interest, at the end of 5 years, he has paid 117,000. So this is just a straight line view.
Yes, sir. So it seems for the first 5 years,
Yes, sir.
what we're actually paying is the interest, not the principal.
It's both principal and interest. But unfortunately, lenders cash out their interest in the first, significantly in the first, maybe in, let's say, a 25-year loan. Lender will have taken almost 70% of their interest in between 10 and 15 years. They will have taken 70% of their interest. So if he's paying just this in 5 years, sir, the interest portion is almost 70% of his monthly payment. The way they design mortgage here is kind of very weird, because how can you be paying monthly? Let's say he's paying 2,900 monthly. Pastor, out of these 2008 monthly, I'm sure interest portion of this monthly will almost be 1,800 or 1,900 or even 2,000.
That's about 80%.
That's how they design loan payment. If you take a look at how you pay your mortgage monthly, what goes to principal and what goes into interest. For me, I'd followed it consistently for a while. 70% of my monthly payments goes into interest. Why 30%? And what they do is, because your loan balance, what they calculate interest on anytime is your loan balance. Not your interest, your loan balance. Loan balance is, let's say, if I tell them I want to know the value of my loan today, they will tell me this is how much you owe and this is how much that has been taken away as interest. So loan balance is what they calculate, not on interest balance. It's on loan balance. That's why they take a small portion of your monthly repayment goes to principal, while the chunk of it goes into interest. Because they want to first secure their hand first. Leaving that, if you default, you are defaulting on the principal, not their. Because cost of capital is what banks and all those financial institutions bank on. So if you are defaulting on your principal, you are not defaulting on my interest. So my interest, I've cashed out on the transaction already. No, pastor, you are the pastor here.
Because you talk about information and the likes, is there any way or is there any caveat that will enable an individual to be paying to the paying cap after monthly scheduled payment? Can an individual be paying extra into the mortgage itself?
Yeah, let me answer that straight on. That's the beauty of using small lenders. Small lenders allow to do as much as 15% of your loan balance and if you pay such, it goes to your principal directly. Big bank also allow you to do it, but I think their coverage is smaller than small banks. Banhe Bank will tell you this is our terms and condition. Their own is just more stringent. In as much as you are putting extra payment, it goes into your principal. But the caveat to which they put as such, so that they can be sure that their principal is still very good in your hand, and they can put as much interest on it. That's why they put a caveat on how much you can put in that will go into your principal annually. Yes, sir.
Well, what I want to say is, I think you've made a good point there. But at the beginning of you trying to secure a loan, I think the best advice I would advise anybody is try and do your rate shopping, and at the same time do your own analysis with different banks, as well as also working with a mortgage specialist.
Very correct.
The reason is because at the beginning of your loan, all power belongs to you. You can dictate to the lender, this is what I want. If it doesn't work for you, I go to another bank. But once you are hooked with them, it is difficult for you to change anything. Like, take for example, when I wanted to secure my mortgage, I employed a mortgage lender to do all that. I'm a mortgage specialist, and the reason why a mortgage specialist is good is because a mortgage specialist can go to any bank and secure any loan, also knows which options you have, which interest rate you have, what is the penalty, what are different clauses, instead of sticking with a mortgage specialist of just a particular bank. If you seek for example, if you seek with a mortgage specialist of RBC, he will only sell RBC package to you. If you seek for that of Scotia, he will only sell Scotia to you. But a private mortgage specialist will go around all the banks. So while the mortgage specialist is doing that, I was also doing my own rate shopping, and at the same time seeking information from different banks. When I met with RBC, RBC gave me a fantastic loan, interest rate. But when I spoke with them, their clause was not favorable with me. Number one, I cannot pay up to 15% of my mortgage if I want to pay that in a year. If I want to pay extra, just as Pastor have requested, theirs was lesser. But the interest rate was nice. But I foresaw that come. It's not only about interest rate. There are other factors and parameters that is attributed to a loan, apart from just interest rate. Some of them will give you a very nice and juicy interest rate, but the clause herein is different. Like, for example, I have a friend. He took one of these private lenders. They gave him a very good interest rate. But the clause there is he cannot rent his basement. That is the clause there. So just going back to what our bishop has said earlier, you have to look at all of those other factors that goes with it. And luckily down the road, I pitched my tent with TD. TD allowed me to pay, I think, 15 or 18% if I want to pay extra payment. But now, when interest rate was down, because my interest rate there was about 5.33, but now interest rate has gone down, and I went again to the market and started searching which bank can give me. I engaged a mortgage lender, go and do your work, go and do your maths. The mortgage lender came, did his maths, told me, okay, there's a bank willing to give me about 3.7. And I said, no, 3.7 is not good enough. I want something better. I also on my own, I went around doing rate shopping. I spoke with my account manager, and I said, come, I have a 3.7. Should I carry your business elsewhere, or what are you going to do? And they were like, okay, they are going to see what they are going to do. Later they came out, they told me, okay, they are willing to give me a 3.6. And I asked, what are the clauses? So that I can compare. That is the stage which we are. So that I don't, because of interest rate, go and lock myself, while I get somebody because of 1% and has, a wider room for me. So those are some of those, measures which you just have to, put into considerations before pitching your tent with any lender.
Thank you so much, Brother Demola. I think you said it all. Yeah. Okay. So it's the same example that this is the first, if you recall, this is the example that we have discussed. So it's the same example that will just be stress testing going forward. After the guy had taken the 500K loan, at least he has paid it for 2 years. Now, I've just assumed to say now his loan balance is now 470. He's still doing that 25-year term. But his term, out of that 5-year term, he has brought it down to 3 years. That means he has done 2 years out of 5-year term. His amortization period is still 25 years. But his term is now 3 out of 5 years. But the guy didn't go back to renegotiate his interest, or he just didn't do anything. He's just faithful as he's doing his own thing. Still at his 5%. Taking that forward, his monthly payment has come down to 2,700. But his interest payment has come down to 67,000 at the end of term. End of amortization to 25 years is still over 300. This is still, it came down from 372 to 350. He just didn't do anything. Everything is just faithful and religious with his payments. So the guy now woke up one day and he felt, interest rate is changing. Let me see what I can do. He was lucky to speak to someone, and he was able to change his rate from 5% to 4.99%. Just 0.01 effect of 0.01%. And why this is important is because mortgage is big. A point difference makes a whole lot of difference. 0.01 makes a whole lot of difference. He was able to bring it down by 0.01. And by 0.01, he was able to save $136 monthly. And the end of term, he was able to save 1,000. And the effect of that is his payments his end of term interest payment came down slightly to 67,473. End of amortization came down from 350, it came down to 349. So monthly was able to save $136, and end of term he was able to save $1,000. Still this same guy, let him take it forward to somebody else again. He was able to change that scenario from 4.99 to 4.50. Still 470K. His term is still 3 years. His amortization period is still 25 years. If he's able to change his interest to 4.50, that means till the end of term, he will save 7,000. That's the effect of 0.50 on his loan. The loan was 5%, but was able to change his interest rate to 4.50. And by that 0.50 change, his end of term saving will be 7,000. And end of amortization, that's if you didn't do anything to the end of 25 years, 40,000 will be saved by changing the interest rate. This same guy again, he was able to negotiate it to 4.0. I'm just doing these scenarios to show the effect of changing or negotiating interest. If he's able to change it to 4.0, by the end of term, he will save 14,000 by end of term. That's till the end of 3 years. If he's able to do that to the end of amortization, he will be able to save 80,000 to the end of amortization period. That's to the end of 25 years period that he has on the loan. The effect of all this is, if you are not able to change the terms of your loan, get some key information that you can use to change your repayment on the loan. And those key information revolves around going back to check your loan term and condition. It's good we take a look at the contract again to know what it allows us to do in terms of interest repayment first, interest penalties second, loan penalty third, and also prepayment fourth. Because if you are able to use either any of these or a combination of all these, our savings on interest will be very, very material. Assuming, using the scenario of somebody putting in extra money in his loan, because that extra money goes directly into his principal, that means at any point in time, whatever he has as the outstanding principal is what will be used to calculate the interest of the loan. And he has been able to put a chunk sum of money into his principal. That means even if he doesn't change his interest rate, at least is making a savings on the interest. But somebody that doesn't now even have an extra money to put into his loan, if he's just able to tweak around his interest rate either from whatever percentage by either 5% or 0.1% or 0.2%, it will make a whole lot of savings around it. And why it's important to look at loan contract is, I think this here is not a country that you sign a long-term or a loan contract and you just forget that you have signed a contract. Is a document that one should sleep and wake up with every day, that what is happening in town, what can I change about this loan? And I will share a brief personal example. The car loan I mentioned that I took when I came to Regina, I drove the car for like almost 2 years or thereabout. I bought that car at 9% and I drove it for like 2 years. But because I was not happy with the rates, because it was not somebody told me, somebody was right beside me signing 5%. And because I was paying for 2 years, but anytime I paid that loan, I will always remember I need to do something about this loan. After like almost 2 years or thereabout, I went back to the dealership that I wanted to change the terms of my loan because I was comfortable. I had a good credit score at that point, and I could even afford to pay off the loan at that point. But I just wanted to test the market to know what I can do with my 9% that I've been carrying for 2 years. You can't believe the dealership was offering me 6% for a loan that I've paid for 2 years. That if I want to continue my loan, if I want to continue my loan, I can bring down my interest to 6% without dropping a dime. It's an open loan. It's a car loan, so it's an open loan. Open loan are not fixed contracts. Okay, I need to mention, open loan is a loan you can refinance as many times as you want. If it's mortgage, because mortgage is termed, mortgage is different. We'll talk much about, I will still share some example around mortgage too. But because of that, when I went back to dealership like almost 2 years after, they were offering me 6% for that loan I've carried for 2 years and I was paying 9% on. I just took it further from the dealership too, because I played a fast one on them. I said I was not going to take their 6%, but instead I returned the car, I took another car, and I brought the loan interest down to even less than 6%.
Okay, I have a question. This is pertaining to the car loan. So, someone told me, and I don't know if it is true, when you want to get a car, yes, the dealership will offer you the loan to purchase that car. And someone told me that oftentimes people have forgotten that their bank can also offer them a car loan. That when the dealership gives you a car loan and tells you, okay, this is the interest rate, you can also go and do the same rate shopping with banks and see that oftentimes banks sometimes have even lesser rates than the dealership. So I wanted to confirm, are we bound to go with the dealership, or you can go out to go and shop for interest rate and go and tell the dealership this is the interest rate I've gotten? Can you match it, or I use theirs to finance the car you want to buy from them?
I don't have too much experience because I've only just worked with Taylor, Toyota, and Lexus. They're the only one I have worked with in Regina. But by Taylor, I don't know whether it's with all dealership. By Taylor, they have banks they work with. They are so proud to say they don't work with every other bank than this bank they have listed. I think it's the 5 big banks, if I remember. I think Taylor Toyota and Taylor Lexus, they only work with the 5 big banks.
Yeah, what I mean is there are like that 5 big banks. So can I, if I have, for example, I'm using one of the big
so
banks.
I'm going to answer that part. So if with my experience with them as well, they didn't let me talk to the bank. They are the one that spoke to the bank. They just told me to fill a credit application. That's what they requested from me. And after filling my credit application, I saw the pool in my credit with all those, with I think 3 or 4 of those banks. Because on their side, they also do a bit of pre-check for you on the dealership side before they even take you to their lenders. So and like out of those, there are 5 big banks. At least I have 2 bank accounts with 2 different banks. I could have walked up to those banks myself. After they said they are going to do the application for me, they are the one that came back with the rates. After they said they did that, I went to the bank myself to confirm the rates. And they told me, because you are buying from Taylor, that's the rate they will offer me. It didn't change. Which I want to believe is a connivance between the brand and the bank. Because if, imagine you are using RBC, you have walked up to RBC yourself to say you want to buy a car from Taylor, and what rate are they going to offer you? I'm too sure RBC will not be able to offer you a better rate than what Taylor themselves will give you, because there's a connivance between the 2 of them. And I know Taylor is big in Regina. Taylor is big around here. Hardly would they tell you they will even take any other bank apart from those their 5 big banks. That means if it's not with their bank or with not their listed banks, it is no deal. And even if you go to the bank to check what rate the bank is going to offer you, they will have locked themselves together that the bank will not give you anything better than what they have given to you on their side. Which looks like a connivance.
Okay, I have a question, but I can speak to that one in 1 minute. Another thing we can do is, what you said is true, because when we wanted to buy a car, somebody suggested us to us, and we spoke to our bank. Somebody in our bank, and the person said he's a Nigerian, he's an assistant manager with TD Bank, and he said, "Don't go there." He said, "Bank will not offer something better." But he said, "But however, if you have some cash with you, you know." Yoruba will say, "Oh, low." If you have some cash with you, you can put it on the table with the tailor or the car seller. Say, "Okay, this I'm putting on the table, and this is what I'm demanding."
Yeah,
you can hold them. You have it. So they will say, "Okay, please come down. You will be detecting." Yeah. In fact, you just when you people are ready coming back, you walk out.
I have experience.
Before you leave, they will call back. Say, "Okay, please, can you come?" So, but you must know how to negotiate at the same time, as something you can put on the table. That's to speak to that. Then my question is, based on what Brother Ami said, now I'm asking, does that mean that, he didn't say it, but I was just thinking, does that mean that loan can be repossessioned? As in, he said he was talking to TD Bank, and he said that another lender was willing to offer something lesser. Right? Yeah. Now, if TD Bank refused to budge, is he going to move his loan from TD Bank to the new lender, and new lender will pay TD Bank off? I'm just trying to wrap my hand around about what he said.
I also could talk to them, but let him go ahead.
Let me answer that question, because it's what I'm doing currently. So at any time during your term, you can always move lenders if you have a better deal. So, so 2 principal things you need to look at is, number 1, what is the penalty you are going to pay to move to another lender? Yeah. Number 2, what is the discharge fee? Yeah. So discharge fee is, if you are moving from one lender to another lender, you pay discharge fee. Let's say you are moving from a TD to RBC. So they have to change the title from TD to RBC on your contract, so they will charge you a discharge fee. So you look at those 2 sums, and then you ask the bank, what is it, if I'm paying an extra payment, what is the caveat to it? Is it 15%? Is it 30%? And how much is it dropping on my interest rate? Like, for example, I was using a 5.33, and another bank is offering me a 3.6, which is very huge. When I did it math together, I discovered that the cost savings of me moving to the other bank is a lot. And I asked them what TD, I asked them what would be my penalty and what would be the discharge fee. And the discharge fee and penalties that I'll be paying is minute compared to what I'll be saving. And the funny thing about Canada is when you seek information, you will get information.
Very true.
Even if you are moving from another bank to another bank, you don't need to bring out that money from your pocket.
Yeah, very true.
You don't need to bring out that money from your pocket. So what I just told TD, I said, calculate your discharge fee and calculate your penalty. Since you guys are now willing to offer me something better, let me know what it is. And they said, I speak with the other bank that I'm moving to. I said, this X number of amount is my penalty and my discharge fee. Factor it into my mortgage with you.
Yeah.
So invariably, nothing is coming out of my pocket.
Very possible. You have experience. Very correct.
So
very,
I'm not paying a single dime
very, very correct.
to move to another bank.
Very, very correct. Very,
Yeah.
very, very correct.
So I'm not paying a single dime to move to another bank.
Very, very correct.
And then the other bank is taking up. So the only thing he did was he just pushed up
Your loan.
my loan
Yeah.
with the X amount of number with that TD called their penalty
Yeah.
and their discharge fee.
Thank
And then, yeah.
All right, Damola. Thank you for sharing. Yes, ma'am.
Thank you, sir. I think information is key in this country.
Very key.
I just want to say something that I heard someone say she did. So on her house, she...
Sit down, man.
Okay, there's this thing, I can't remember the exact name now. Like, she refinanced her house. So usually people refinance their house to take out some money to use to do something else.
That's home equity.
Home equity.
Yeah.
But when she refinanced the house, what she did was to put it back as principal into the house. So that now brought down this thing.
Yeah.
So, and there are also some things so that we can do that can actually bring down these things, like bi-weekly payments. Recently, my husband and I were checking our loan this and realized that we saved how many years? 2 years by paying bi-weekly. So there are some, and the thing is, all these things they won't tell you. It's just from research, and it's also from having to go out of the way to just search these things.
Very,
Praise
very,
the Lord.
very correct. Please ask. We are discussing and sharing experiences, and we are also learning from each other. So as much as you want to, please go ahead.
My question is simple. She mentioned refinancing.
Yeah.
How long does it take before somebody can refinance it?
Okay. You can refinance as many times as possible based on your terms of loan. If you have done, like Brother Damola shared, mortgage by term, if you want to break the term of your mortgage, it's as good as you are refinancing. And if you are refinancing at any point in time, penalty is what you pay. I did a refinancing. I just did a mortgage refinancing when this interest rate change started. I was paying 4.75. And I'd been on the trend of interest rate change. I was just looking at a good time to take my position so that I could move ahead as well. I was able to crash my interest rate from 4.79 to 3.75 as well. And I also didn't pay a dime. And all I did was, I just called my bank, what's my interest penalty? I have been very familiar with my contract anyways. And it's in my contract, because I didn't borrow from a tier 1 bank. It's in my contract that my interest penalty is just 3-month advance payment of interest. Big bank do much more. They can do 6%. They can do some very terrible clause on interest rate penalty, all because they are dissuading you from moving your loan to another lender. So what they hold you with is the penalty of interest. It's payable, but when you sit down to calculate how much will I pay as penalty and how much am I going to save, even if I change interest rate or I change lender, he might probably have wiped out whatever you are saving on. That means you are stuck. So if we don't take advantage of looking at our contract first and knowing even the implication of our contract, man, just not take advantage of so many things that we can do to save our interest. And as Pastor Mommy said too, that bi-weekly payment is also a big savings for loan, because it helps you, like you are doing something called accelerated payments into your loan. If you pay as chunk too, chunk prepayment also goes directly to your principal. But even if you can't now do all of these things, go and, if it's possible to work on. And some people said if they look at their penalty to what they are even doing or what they are going to save based on interest, it has wiped out all their savings. That means they are stuck on that loan. And somebody will say if he's trying to change his interest, that his interest configuration, we said most of what you pay as monthly repayment, a chunk of it goes to interest, not even principal, like the 2,900 that we shared. Because 2,000 goes into your interest, while 900 goes into your principal. Some people said if they want to refinance or change their structure, that means, and they have put in some, I had somebody shared with me that he has put in so much money into his mortgage. And because he has put in so much money, now his monthly repayment, if he pays 2,900 monthly, like almost 2,000 or thereabout is going into his principal, while 900 is going into his interest. When you have paid so much into a loan, because you have accelerated your payment, it has brought down the terms that a chunk of the money you are putting down is not, a chunk of it is not going to interest anymore. It's now going to principal, because the bank has cashed out on your interest, on your loan, because the bank has cashed out on your loan. So the person was asking me, if he changes the interest now, will he now go and start all over again with another lender? There is a clause for me that he's thinking about. And I said, you need to sit down and know what you want to save, or what you can save first in terms of interest rate change. Because loan interest or whatever interest rate is calculated on your current balance of the loan. On the current balance of the loan, which is your current principal of the loan. Bank's interest is secured. In as much as you are paying your loan on a monthly basis, bank interest is secured. And in a 25-term loan, I'm sure bank will have cashed out their interest in 10 or 15 years. They will have cashed out almost all of their interest. So if you fumble around with the balance, you are fumbling around with the principal. They have made their money and they have moved on to somebody else. So having a strategy around loan, whether mortgage, whether personal loan, I think is a key have for everybody. Because if you have a strategy, is you sitting down to know whether your strategy is around repayment, whether you want to choose bi-weekly or monthly payment, or your strategy is around prepayment, putting advance into whatever loan you have so that you can bring down your principal and you can save on interest. And if you cannot even now do all of these, take advantage of interest rate change. And before you also take advantage of interest rate change, go and look at your terms and conditions. Because if you have signed up with a big bank and 6% or whatever, and they are charging you advanced interest payment of 6 months ahead, that means before you even make a savings, is wiped, whatever is wiped off already. Also, yes, sir.
I have a personal question, sir.
Yes, sir.
Yeah, so the way it is now, just like my wife said, so it's now 18 years, about 18 years. We took a loan for amortization period was 25 years. Okay. By changing it is now 18 years. However, we are one of the fortunate ones in the era of 2%. And the mortgage is coming up for renewal 2026. What will you advise?
Pastor, it's no two-way answer.
Yeah.
You can trigger the refinance early if you want to take advantage of interest rate change. Why? Because the economy is very, very volatile as the state that we are now. The next interest rate change is in January. it's been going down like almost, it's just in December that they didn't change the interest in the last few months or thereabout. January, we are not sure of what is going to happen around interest rates in January. But because what you hold now, or interest rate now, is what you know and what you can predict, you might want to know what you can do. And if you want to know what you can do, whether you want to bring forward the financing earlier than next year, is first going to look at what's your penalty for breaking before term. Because I know, because it's still next year, it won't save you interest penalty. If you have done, if they said 3 years advance is your interest penalty, even if you are breaking 3 months or 3 weeks to the end of term, you will still pay that penalty. So it's first looking at what is your penalty for breaking the term. Because whether it's next year or next month or thereabout, they will still hold on that you didn't, your loan didn't run to the end of term. So if you know your interest penalty, I think is a stepping stone to have further conversation of whether you want to bring forward the refinancing because the interest rate is good now, or it doesn't pay you to break the term now because the penalty is huge. So if you don't know what you can do at this very cross junction, you might say you will not do anything to the end of term. And because you got that good rate that everybody is looking for, you might also don't want to lose it for anything else. But I think the key thing is just first know the implication of you bringing your terms earlier than what it should be. Because bank, they are so stringent on you making your loan to the end of term. So if your term or your penalty for breaking your loan before term, if it's lesser than what you're going to save locking or changing your interest rate now, I think it's a good deal.
So the second, okay.
Can you get anything less than?
With God, all things are possible. I know that was a miracle because I looked at the interest rate even before then.
We had a chart.
The last, okay.
We had a chart. That was
oh,
the chart
okay. Sorry.
Yeah, that was the first chart we had. Oh. So, oops. So, post-COVID, that was when the economic recovery started. Post-COVID was this chart is from 2020 to 2025. Post-COVID was 1.25. That's March 2020. It was 1.25. When the recovery or that COVID thing really hit bad, the interest rate fell down to 0.05. That was in March 2023. Sorry, 2022. And then the rate started climbing from 1 to 1.5 to 2.5 and so on and so on. And the highest it has ever been, it was in July 2023 when the rate was 5%.
Is this mortgage rate or this not?
This is interest rate chart.
This interest rate.
That's interest rate. This
Canada's plus
Bank of
X
Canada
now will not be mortgage.
Plus prime
will be mortgage.
Because it's only Bank of Canada that does this.
Okay.
Nobody can do this apart from the Bank of Canada. Yeah. So this is plus bank rate. Yeah. It's not fixed. It's the regular interest rate. 8 point some. Yeah, because that means I suspect that person will have borrowed maybe at variable at that point in time. Yeah, at variable at that point in time, because it's only Bank of Canada that has this rate. Nobody borrows at this rate than Bank of Canada. So it's plus the person had borrowed Bank of Canada rate plus his lender's rate. That's what took him to 8%.
The current prime rate is
2.25. Yes, sir.
Meaning that there's no bank that can go below
It's the only
as
bank
at
of,
today.
You can't get it anywhere from except you are borrowing from Bank of Canada.
As at today.
As at today, yeah. The rate, there was another rate change. There was another rate change on December 10th. During this week, they retained 2.25.
They still maintain 2.25.
Yeah, they maintain 2. That's Bank of Canada rate.
Yeah. That's the question. Okay.
Yeah, that's how much they lend to bank.
So then the question is, how can I approach Bank of Canada?
Pastor, you need we need a heavenly contact, sir. you need, yes, ma'am.
Okay, I just want to say something. I know by the grace of God, we are all going places. So I've heard the story of a particular family. They were living in, I think, maybe Manitoba. So when they were moving to Saskatoon, of course, they need to buy another house. They got their rates transferred on the new property.
Wow.
I don't know whether you get what I'm trying to say.
I get you. I heard you clearly,
Like
but
they didn't.
I didn't know
Then
it
the
was
rate
even
has started
possible.
increase. They did. It's a family friend of my sister.
You know, bank, anything can
They
can
got their
happen.
rates
Anything can happen.
Yeah.
anything can happen. Anything.
So I have a mortgage interest of 2.1% with TD Bank since 2021. My term ends in September 2026. I requested to do bi-weekly payments to reduce interest payment, but they demanded a certain amount first. So I don't know if this is a question or a comment or contribution. It's online.
I don't know. I don't have experience with the big banks, but big banks dictate terms and conditions, which either you do it or you don't do it. So that question of they demanded a certain amount, it's the bank. It's a bank thing. And if the person thinks otherwise, he might want to either break his mortgage with TD Bank and look for a more friendly bank for a better terms and condition, or he negotiates the other way around with the bank. That's pretty much what I can say. I don't have the big bank experience.
The experience that we're using Scotia,
Okay.
and it was on monthly. So when we approached them, we didn't pay any penalty, but they allowed us to change it from monthly to bi-monthly.
Bi-weekly.
Bi-weekly rather,
Yeah.
and that was all.
And you didn't pay penalty.
No penalty. But I think it's also boiled down to the clause that you have been talking about. Unfortunately, sir, I didn't even check the clause. I just went there, but I was able to change it to bi-weekly. But we wanted to change it to weekly. But the point is that they said that it's better to make it bi-weekly, because if we change it to weekly, to change it back to bi-weekly,
that
will comes with another cost.
Yeah,
cost. That comes with the cost.
You pay. Yeah, we pay to change again.
That it's better to move from monthly to bi-weekly and stay on bi-weekly, even if you want to be paying, in your head wants paying weekly. But if I move from monthly to weekly, which is possible, but to now move from weekly to bi-weekly, that's where the problem will be. So we just left it at bi-weekly.
Thank you for sharing.
Thank you, sir. If I want to speak to that question with my little understanding from what I've been learning from, say Bishop Shola now, it's very simple. I will say that that certain amount of money they ask him to pay, I will say, is the penalty. They are not declined based on what he said now. That I want is on 2.21%. Am I correct?
Yeah, that's the rate.
And he was on monthly payment, right?
Yeah.
And now you want to change it to bi-weekly, and they ask him to pay certain amount of money. They are not saying they are not going to accept bi-weekly, but before we revert to bi-weekly, he should pay that penalty. That's what I think about it.
Good afternoon.
Yes.
Yeah, I just want to ask, the weekly, is it based on the amount you are paying, or it has to break down? Like, if I'm paying $2,000 monthly, then I have to break it down to like maybe 500 weekly, or is the same amount I pay? Just for clarification.
I think I'm not a banker, but I think it should. It's not dividing 2,000 by 4. Let's say you have 2,000 monthly, and you want to do weekly now. 4 weeks in a month. That's 500 month. It should be 500, but I don't think bank work like that.
Okay.
Yeah, and their own breakdown, I'm sure is what should cover the cash flow they have put on the loan repayment. So not that you dividing 2,000 by 4 and say you'll be paying 500 weekly, then you paying just lump sum. No, it works on you. They meeting their cash flow repayment projection on the loan than you just dividing 2,000 by 4 straight. It doesn't work that straight.
Well, what we did, sir, is assuming we were paying 2,800.
Okay.
So technically, it changed to 1,400 bi-weekly.
That's half it.
Yeah.
Okay.
That's half it. But the other thing is that when you are doing bi-weekly, you are paying 1 month extra.
1 week
One
extra.
week.
I think 53 or 52. Yeah, 1 week extra.
So you're paying
Yeah.
extra.
Yeah.
That's number one. Number two, also, don't also forget from what you're saying that it's about what is the principal.
That's what they call it.
So, although at the end of the month you have, for example, it's at the end of the month you are supposed to have 400, but because you are doing bi-weekly, the next month, at the beginning of the month, is not that amount if you are doing monthly.
Yeah.
I don't know whether you understand what I'm saying.
Yeah,
Yes. Then in addition to that, you have 1 month they are paying extra. I think one repayment that is extra compared to if you are doing just monthly.
Okay, thank you. My second question is, if you want to break if you have a high rate, and you want to break it based on the what the lender or whoever that borrows you money, like if you have the highest, like what you just said now, that you have to compare the two.
Yes.
Which is if you have the highest one, what's
highest
like,
one? Now, what do you mean?
Like if your rate is high, like
and
if
your
penalty is high too. What can we do?
I would rather say look at your savings. If your rate is high and your penalty is high, but if because you are bringing or you are crashing your rate down to something lower, you make a saving. So what you should invariably do is calculate your savings first, take out your penalty next, and see what is next. Because if you have a difference, that means you are still making a gain.
Yeah. Thank you so much. Thank you.
Yes. Any other questions, sir? Yeah.
Hello? Okay.
I'm with you, sir.
So on the credit score, we have 2 credit scores. The Equifax and the...
Yeah, 2 credit organizations. Equifax and TransUnion.
Union. So now, and the differences between the two is just like heaven and earth. Sometimes you see the one you have...
They can be very funny.
Very good rating. Now maybe like you are in 800 in one, and one you are in struggling to be like 737 something. So I need to know, because some people, like when we went to get the car, they use the one that has a lower, the one that has a, so that's the Equifax is what they normally use. So what's the difference, and how do one now say, okay, if you have 2 different organizations that are in charge of credit scores, which one do you think?
I don't know which is best between the 2 of them, but as you said, every organization has their own source. It's just there are 2 main credit sources in Canada, TransUnion and Equifax.
Yeah.
But the lender or who you are borrowing from is at the liberty of choosing whichever organization he wants to use. Some use TransUnion, some use Equifax, but by experience, the big lenders use TransUnion or Equifax, because some people justify that Equifax is a delayed platform to TransUnion. So some felt for dependability and for unification of interest, TransUnion is preferred to Equifax. But maybe by law or by establishment, both two credit organizations are the most credit are the two credit organizations, two credit rating organizations in this country. But unfortunately, your lender is at the liberty of pulling from each of those platforms. And some also said it's a timing difference. Because if you check your credit report, there is a credit report pull date for everybody. That's the date which your credit is pulled and your score is updated. In some platform, your credit report date differs from each other. Like mine, I have one that gets updated every 30th of the month. And I have one that gets updated 11th of the month. But for me, the beauty of it is they both use credit union. So I just know I see my score earlier in one place, and the other one will catch up the following 11 days after or thereabout. So I just don't bother myself with whatever rate I'm seeing on the late one, in as much as I know the updated one is one I rely on, and I move on. But when you are borrowing or whatever lender you are talking to, they are the liberty of pulling your credit from whatever organization they have chosen to. You can dictate to them.
Now, the issue I see there is that there could be as high as 100.
No, it shouldn't
difference.
be. It shouldn't
80
be.
something, 70 something.
I've not heard of that.
Yes, yes.
The one on the phone is not always accurate.
Okay.
Yeah, so the one done in the bank.
Okay.
The one on the phone will just give you a
The bank has a live portal access.
Yeah.
That's also the what you are seeing on your phone or your computer for credit score is not it's sometimes, but it's not always, because bank and lenders have access to live score. Bank and lender put your live score, not your updated score. Yeah. So, sir, the one you see even on the bank account, I think is also your report. But when somebody is pulling your credits, it's your live score they have access to, not your reported score. But if you now didn't do any transaction or nothing changing in the course of the month for you, that means what you have as your live score will be the same as your report score.
So another thing I wanted to say is this is based on my personal experience. So different banks have the way they pull your debt and liabilities. They have bank specific methods they use. Let me give you an example. In RBC, I wanted a line of credit. So I asked them, how do you pull your credit? So in RBC, what they do is, even if you have collected line of credit elsewhere, it doesn't matter, as long as you've not used it, or as long as you've paid it back. So let's say you have 50,000 you've collected elsewhere, somewhere else. So that 50,000 will not be attributed as your liability. It will still be there, but it will not affect when they are pulling that credit. But in Scotia, even if you have collected 50,000 a year, 30,000 a year, but you've not even used it, it is a liability. Yes, it is a liability in Scotia. So different banks have different specifics. So sometimes you try to learn what are the specifics of each bank, and you play a fast one on them. So knowing that, what I did was, instead of approaching RBC for a line of credit, the first thing I did was approach Scotia for a line of credit.
First one.
So I approached Scotia for a line of credit. Scotia gave me a line of credit. So when they gave me that line of credit, and we know the system, right? Just make sure that if you need another line of credit, make sure within 1 or 2 weeks, go and grab it before that record changes. So, yeah. So that line of credit I've gotten from Scotia, I knew it would not have reflected in either TransUnion or Equifax. So immediately I went to RBC. And RBC could not see the line of credit that Scotia had given me. So I got another line of credit from RBC. I don't know if anyone understands. So
that's a fast one.
We all know how we came to
I've not heard of that before.
Yeah.
I think it's about the timeline.
The timeline, and also knowing what are the specifics. Because if I had gone to TD first, and I go back to Scotia, the 20,000 or 30,000 that RBC has given me will be as a liability in their own calculation in Scotia.
Yeah.
You understand?
Yeah.
But for TD, even if they see it, but even if they see the money that they've given me in Scotia, they will not count it as a liability for me for my credit pool. So different banks have different ways they calculate it.
You know the system better now.
Thank you, sir. I just want to mention that the more they do a credit search on us, the more it impacts on our credit.
Yes, definitely. Yes.
Like they will deduct out of your credit. If you go to buy a car and they do a credit search, your credit score is being impacted. You keep going to get this thing. Like we need to factor that in.
That
If you have a very good credit score, then of course you can
draws.
keep going around.
Yeah.
But if not, then you need to be mindful.
Yeah, and I think on top of that, I had a personal experience. We are trying to fix a water system in our house, and I called a guy to help us fix, like call all those Corgan people that sell water and the rest of it. And I was putting I had a monthly payment with them because it's going to be a plan for like 3 years. And to my surprise, I want to buy water, and they are going to put my credit for water. I was putting the repayment on my credit card because I even gave them my credit card details so that it's not that you want to put money from either a direct debit from my account or it wasn't really that. But to my surprise, I saw them pull, and it affected my credit score. No, they did. But when they were asking me for those details, I gave them my credit card details and the rest of it. But to my surprise, pull my credit. I think they told me, but they said it's a soft check it doesn't impact your credit, but it showed the access, but it wouldn't impact your credit score. That was what they told me. But it's a hard score on my credit that is in my report. I called them afterward to say, but you told me it's a soft check, and I've given you my credit card details to be deducting the monthly payment from my credit card. So how did it get to my credit score? He said, unfortunately, they can't help it. I felt like these people can be very, very funny sometimes. So the impact of all those small check, soft check, side check, middle check, it's really gets on our credit score. And if you don't pay conscious attention to it, every canary that just access one credit will just mess up one credit score very unnecessarily.
Yeah, so for me, right, when I was doing that too, just as I said, information matters. So I had gathered some information that if you're pulling your credit within 1 to 2 weeks, the impact is always minimal on the second one. Yeah, it is the first one that hits. The impact is always very minimal. So when Scotia pulled, that was a hard one. But when RBC pulled, it was so soft that I saw little or no impact on my credit score at all.
That's interesting.
Okay, maybe a little away from, but we still what you are discussing. I want to ask, maybe you can throw more light on this for me. Scotia Bank sent me a message and a letter to that they want to give me line of credit. I've never approached any bank for line of credit, none. And it's not left for me to decide whether I will take it or not. So I'm still, that was just last week. So I want to know, do I take it or not? And this bank again, CIBC said they want to, but they are asking, they say more credit, more. They want to give me more, increase my credit limits. Then again, TD, the same thing. Yeah. But it was only Social Bank that asked me for that they want to give me a line of credit. They call it personal line of credit. Yeah. So what do you suggest?
I would say take it and take it and don't use it. Thank you. Take it and don't use it. Why? Because those are part of their incentives on bank account. Some give credit card, some give line of credit without you even applying. But the impact of that is it will not impact your score. So even if you take it, it doesn't change anything. Even if you lose it, it doesn't change anything. But the beauty of it is take it and not use it as he said. If it's there and you don't use it, it doesn't change anything. However, it's part of your credit portfolio. But the use of such credit is what impacts your score. And even for credit card increase too, even if you don't use it, take it in as much as it's not taking anything from you. Because whatever it takes from you is either impact your credit score or impact your loan portfolio. But in as much as all those, they use it as like a complimentary service for banking with them, for holding an account with them and the rest of it. I used to accept almost all of it then, but later I stopped. It's getting too much for me too. Why? Because I have too many already. That's why I stopped I stopped accepting. Like I helped my last account. I have 2 accounts basically. I used to have 3, but I had to close that one. That they just my last account is with BMO. BMO had been chasing me around for credit card, for line of credit since I started that account for almost 2 years, and I've refused. I've continued to refuse till date because I felt I had one without BC that I can't even exhaust, and I don't need an extra credit card anymore. So that's why I stopped accepting that. In as much as it doesn't impact my credit, but I just felt the one I have without BC is too big for me to even use as a line of credit. So I just didn't take that. But if it's credit card increase, credit card increase doesn't do anything. In as much as if you are not taking a new credit card. I want to believe it's a credit card you have already. They are just increasing your limit on the credit card. So by such limit, it won't impact anything.
I have a question, then a suggestion. If I take it and I don't use it, will it impact positively my credit score?
It doesn't change your credit score. However,
so what I'm saying is,
the use is what impacts your credit score.
So what that means is that I have a limit. So for example, I have a limit of 5,000.
Yes, sir.
And I've used 3,000. So that means 60% usage. But if I change it to 10,000, but I still retain my 5,000 and I'm still playing within 30,000, that means I've now reduced my use. My exposure is 33%.
Yes, sir.
As against 60%.
Yes, sir.
Won't that have a positive impact in my credit score at the end of the day?
Yes.
It will, right?
Yes, sir.
Yes, okay. That's number 2. This don't use it. Sometimes it's easier to say. Don't use it, I said. That's when they'll come in need. Sometimes it's after you have accepted, the next day. That's when the need will. I don't know that you have been there before.
I've been there before. but the impact of such is because it doesn't change anything. Accepting or rejecting because it doesn't change anything.
So if I want to come in there, sometimes it's like a catch-22 scenario. No one is better and no one is bad, right? If you don't accept it, if they give you the promotional offer, my advice is take it. If you don't want to use it, don't use it. If you want to use it, use it. The reason is because when you need it, and you now need to approach the bank, then the bank will have to credit pool you. Those promotional offers don't have credit pool. They are just giving you based on the promo. So let's say maybe 1 year down the line or 6 months down the line, you now need that. Then there will be a hard credit check on you. And you wouldn't want that on something that they've given you as a promo. Free of charge.
Thank you very much. I've been following this since you started from home. So I have 3 questions. Number 1 question is, I was one that asked about that online question. Okay. So in 2.1.
Okay.
So, and it will be, the end of the term will be in September next year. Okay. So I went to TD Bank to request for, because I didn't get to know about the bi-weekly payment until maybe sometimes last year. So I started changing all my other payments, other mortgage payments to bi-weekly. So I approached TD Bank that I want to change from monthly to bi-weekly since I didn't have to pay for other banks to do that. So the person, in fact, the person is actually a Nigerian man. So he was like, oh no, before you can do that, you have to pay. He calculated something. I said, I didn't have to do that in Scotia Bank. And I didn't have to do that in so. So why that in this? Is it not the same monthly this thing? There is no reduction in the payments. And it's just to change from, in fact, when I wanted to do the mortgage and all, what I was asked was, do you prefer bi-weekly or monthly? When I wanted to start the whole thing, because I didn't have any information and all that, I said monthly is more convenient for me and all that. Now I told the man, I said, see, do you know what? I think the bi-weekly is convenient for me now. He said, no, you have to pay. He started calculating something. So I said, okay, anyway, don't worry. I will do my research and all of that and come back. Now the second question is about when one wants to buy a house. I read something on Instagram where they said instead of you doing the huge down payment to reduce your mortgage, what is it called? Exactly, that one can do, sorry, I'm not so good with those terms and all of that, that one can, instead of paying huge amount of money, so that you can reduce the amount of the
mortgage exposure. Yes.
Exactly, yeah. So that instead of doing that you don't pay all of that, that instead pay certain amount, then now start paying towards the, what is it called?
To pay down.
Principal and all of that. So I was like, which one is better? Because another person told me that it's actually better to pay huge amounts before so that you have a reduced amount and you have a reduced interest rate and all of that. Then my third question is about the car. When I wanted to buy my car, so I went to Mercedes-Benz and all of that. So we were talking about the rate and all of that. So at that time, the rate was a little bit high and all of that. So I went to my bank, because my my business specialist said, I told him that I wanted to do this and all of that. So the person said, oh, we can offer you that there's something for doctors and all of that, that they were, they were interested, they wanted to take it up, and they were like, oh, this is part of the things that you can enjoy with us and all of that. So we started talking. So I told the guy in the Mercedes-Benz that this is what my bank wanted to do, and this is the rate they want to offer me. Immediately, the following day, someone that was proving difficult just called me the following day and said, do you know what? We can beat down that rate. We can beat it down. So I was like, which one should I do? So I started saying, why it is better to do with them down. So I said, the bank also said it's better to do with them down. So I became confused. So I was like, okay, let me just go with you guys since I know. So, but when I heard you talking today, and the rate they gave me then was 4.9. That was last year and all of that. So looking back now that the rate is going down, is it possible for me to still go back to them and tell them I want that rate reduced to?
Please go and negotiate.
And they will not penalize.
It's an open loan, ma.
Okay, sir.
Car loan and every other loan, they are open loan. You can refinance it or change the lender as much time as you can. In as much as your credit score is good, because they will take it as if you are reapplying for a new financing. But the beauty of it is not on the full amount, it's on the loan balance that you have on the car at the moment. So going to another lender or changing the interest rate with them, I think it's something good.
I want to ask you a question.
Okay.
Okay. My question now is that if you go back to renegotiate, thank you, sir. If you go back to renegotiate, and now it's brought down to, let's say it's brought down to maybe 3.5 or 3.7.
Yes, sir.
Now, that 3.7, let's say next year, the interest rate now
goes up.
Yes.
Yeah.
So what will happen to that 3.7?
Your rate is not a change. It's not a flexible or variable. It's fixed for that loan.
Okay.
Is you are the trigger of changing the rate.
Okay, understood.
Because the rate they are giving to you is not even what is in the market rate. It's the rate that either the dealership and the bank had done their collaboration to do for the brand of car and also for the amount of the car involved. So even if interest rate changes, you can also keep paying that interest rate. They are not at the liberty of changing such interest rate on you without notifying you or however they want it. Because for my own scenario, I paid 9% for 2 years and nobody called me to reduce it for 1 day. I don't know if I can answer.
She asked 3 questions, so we need to answer 3 questions. Yes. However, I want to say one more thing concerning the car, then the other one concerning the TD. The one concerning the car, if you go back there and they are able to change it from what Brashola said to, let's say, lesser, please make sure that you pay the prophetic offering to Bishop Shola, because he must have saved you some money. So advisory fee, make sure you pay advisory fee, because like we've learned today, 0.01% matters a lot. Yeah, exactly. Yes. So anyway, that's on the lighter note. However, for the bank, one of the things I've come to realize is that you approach an organization and they'll tell you something. You call them, you go back again, you meet another person, they tell you something different. And different people tell you the different things concerning the same product. So, but I would advise that number one is to check the terms of your terms of condition first for the loan. And based on that, then maybe you could approach the bank. Maybe not the other person. Maybe another person. Maybe not that bank. Because sometimes based on the knowledge that people have and they interpret it to be this is the standard. Some people is just having initiative. This is what they say we should do. This is how we should do it. And that's how it will be. And that's how, but they're not so flexible. Why some people say, you know what, let me ask my superior. Let's see what we can do about it. But I turn it over to the adversary financial experts.
I think from the third question, which was on the question of the car, I think that was the third question. There's no two-way thing about it. It's an open loan. You can change or refinance or do whatever you like on the loan as many times as you want. And why I think such dealership will change to meet up with the bank rate is they want to sell, number one, and they are not also fixed or stringent as Taylor or whatever brand is, maybe in my own thinking. Because if that you have not gone to the bank, you'll have signed with them for that old rate that they were offering you. But good that you went to the bank, did some rate shopping as well, then came back to them. It gives us the leverage of, if we have such opportunity to speak or shop for rate for any transaction we are doing, the onus is for us to do such first. Because lenders, they are just sitting very comfortably in their shop or their dealership. We are the ones that have taken business to them in the first case. But a bank or whatever lender institution we have gone to, we are the one that will choose which lender we want to take our business to. But for dealership and also even the big lender banks or the big mortgage banks as well, taking business to them gives them that position of dictating the rate they want to us. But if we have comparative rates that we have brought to that, they have gone to Scotia, I've gone to RBC, this is what RBC is offering me. Are you going to take this rate for me, or you want me to take your business to somewhere? It triggers them to do something that they don't want to do either to meet up the rate. But in just doing that, I think what I really want to make mention there is their terms and conditions is also very important. Because somebody can give you a good rate and use a stringent term to tie you to the contract that he has signed with you. But doing rate shopping, if you have such opportunity, I think is a big advantage one should not trade away in any transaction. Because if you have just immediately you sign, then it becomes you are coming back to break your agreement. But before you sign and you make all your shopping and make all your findings and you decided to settle with the rate that is best for you, then it puts you at the place of advantage than just walking up to them and signing their own terms and conditions or signing their rate as the case may be. So they might want to sell. I had this almost similar challenge too, but Taylor was not giving me the option of going window rate shopping. They just said it's just these 5 banks or nothing else. And I went to RBC afterward. RBC was giving me the same rates Taylor was giving me on that same transaction. And I saw them sign somebody for 5% and I signed for 9%. I walked into it joyfully because I didn't know. Is it the third or the first question now? I think okay, on the change of the payment. Honestly, it's actually a bank thing, and anything is possible with the bank. They do anything, and anything is also possible with them. But in changing your terms from either monthly or bi-weekly, I also don't think it should attract any extra payments. But as I think Pastor Akambi Obradamola said, they might want to charge you penalty for changing your terms. But it's not that you are reducing, it's not that you are even reducing the amount of repayments on the mortgage. It's just you changing a flexi condition from monthly to either bi-weekly or weekly as the case may be, and somebody is saying you are going to pay an extra for that. I think you should ask more questions. Because ordinarily, you said you have even done with some other banks and you didn't have to pay an extra for that. So I think it's awkward, or is the bank taking an advantage of you for charging you such extra? So what's the, have I missed any question? Is it the rate? I thought she was talking about the payment or the rate. Yeah. Yeah. I think mortgage and loan portfolio, one should have a strategy, ma. I think that's the most important thing. Some people will say when you want, even if you have 20% down payment, don't pay 20%, just pay 5% and use the other 15% that you have in your hand to either do a bulk payment back on the loan or you use it for something else. On that decision point, I've also been there at one point in time. But for me, I was happy I didn't pay more than 5%. Why? Because I needed the other fund for some other things. I could do 20% when we were buying our first house. But we had a lot of fight and we chose not to do 5%, not to do more than 5%. Why? Because I felt I would do some saving, because I know if you pay more than 5%, you will save on CMAC insurance, which is also a saving. But however, the cash flow in your hand, immediately you tie up the 20% as down payment. That means whatever rate that you have signed for 20%, or so whatever rate you have signed for at that point, has denied you the opportunity cost of doing something else with that extra fund. So the approach around it is, first, if you are able to pay 20% or whatever percent you are putting down, and you are getting a savings on the interest, it might be a consideration. Because putting more than 20% or whatever percentage that is required, it should have something you are getting in return for doing much more than you should have done, which is the basic minimum. So if it doesn't pay to put more than that, and you could do something else with that cash flow, and you are not getting anything in return, whether it's a reduced interest rate, I would rather have said stick with the minimum payment. And that leads us to the point of the extra payment. Should you now have put it back as a bulk payment? Yes, you can. If it's also a good approach to bring down your loan, your mortgage balance, and also help you to save on interest. But at the inception of the loan, if you negotiating because you are putting much more money down and you're able to crash down the interest, I think it pays to do it at that point. But if it's not going to give you an extra or added advantage, I will say no. It's not a good use. But if you do that 20% or that 5% or the minimum percent that's required of you, and you put in lump sum payment afterward, it's going to help you do some savings on interest, then it might be a good approach not to put more than the basic minimum percentage required and put it back in there. I want to share an example that I heard from someone. The guy was sharing with me, somebody came from Nigeria, maybe last year or thereabouts, and he bought a 700,000 home cash down in Winnipeg. And I said, is he in his right senses? And they said he retired from one of the big oil companies in Nigeria, and he brought a lot of money. I was just sharing with my friend that if I have 700,000, I'll buy 7 houses and put 100K in all of those houses. And the two of us will come back at the end of 7 years to compare our portfolio. Because that he has 700K and he's putting 700K cash down in the house, I think it's a waste of resources. It's his money, it's his choice. It's a terrible financial advising, very terrible one. Because the minimum required to buy a house here is 5%. Even if you want to do much more, you can do 20%. And somebody decided to do 100% cash down. And the funny thing here is, Canada, the lender will accept it joyfully. Joyfully. Because how would somebody put 700,000 cash down to buy a house? Pastor. It's a faulty mindset. It's a very faulty mindset. Because honestly, let's do a 7-year comparison, and let the two of us meet together after 7 years. Because he has not done well with that 700K at all.
Yeah,
Okay.
he may have more. He may have more, and that 700 is just a peanut.
It's a waste. That
But
700
yes,
is a
we
waste.
know.
It's
We
a
know.
waste.
Yeah. I just wanted to chip in something. From my little experience in Canada here, I think one thing we should have at the back of our mind is there is nothing you cannot negotiate. For me, if I meet you as a lender and you tell me it's fixed, it's even a red flag for me to leave you. There is nothing you cannot negotiate. Even as trivial, as low as access communication, our normal internet. Do you know we all don't pay the same thing? We all don't pay the same thing. Let me give you a very simple scenario. Just very simple. My 2-year contract terminated with Access. And automatically they bumped me up to over 100 and something. So immediately I got that, I called them. And I said, come. Number one, I am going to sue you guys for increasing my money without even informing me that my contract is over. Then they were apologizing. And I said, secondly, I did not tell you that I'm going to do business with you after 2 years because I have another competitor that's giving me something better. And they said, okay, what are they offering me? Honestly, I did not speak with Saxtel. I have no idea of how much Saxtel is paying. I just told them randomly. I said, because currently I was using 350 and I was paying 72. And I said, come, Saxtel is offering me 1 gig for the same rate I'm paying. And I said, am I sure? I said, yes, that I am going to terminate it. You guys come and pack your thing, and I'm moving to Saxtel. And the lead said, okay, you know what? Hold on the line. Let me speak with my manager. Within 5 minutes, she came back. She said, okay, you know what? We are going to match it and even give you something lower. So I am paying less for higher value.
You know this country too much.
There is nothing you cannot negotiate.
Very
there is
honest.
nothing. Because they will prefer to still continue doing that business with you than carrying that business elsewhere. Yeah. Little savings here and there adds up to something. At the end of the month and at the end of the year, you see what you've saved. Yeah. You'll be amazed. Please, let's have it at the back of our mind that anything they've given me, number one, let me do rate shopping. Number two, there is nothing I cannot negotiate. Even if you don't get what you want, you know you satisfied your curiosity that, oh yes, I have done my part.
You have.
Thank you.
Yeah. Praise the Lord.
I think 5 weeks ago, something just, I don't know what happened. I switched my network provider from Bell to Rogers. I experienced what he experienced. And Bell called. After like a week, they called. You are no more on our network. What is happening? I don't know. I got tired of you and all that. What is? So 2 days after, they called me and they give me an incredible offer to bring me from Rogers back to. And I said, what are you? They said you'll be paying $30. I was thinking maybe with Rogers was like maybe like 55 or $56 or something. That we give you $30 and some unlimited data. And I said, how? I said, can I go to any of your outlets to get it activated? They said, no, that this one is private. That you can't see this kind of offer in any of their offers. I said, okay, what of the money I paid? You know, there's this money, I think $80 that they said we will pay everything, we will give you back and everything. I said, okay, no problem. Joyfully, I returned back. Sorry, my next question is, I noticed something recently.
I'm sorry, Brother Jamala, your headlamp is on. You might want to. Okay.
I noticed something recently that the whites, I don't know, maybe you've observed, they use more of cash. Yeah, than the cards.
I know farmers carry money around. These farmers I know carry a lot of money.
What is driving that? No, what is driving that? I've been observing, while maybe if you want to pay, maybe in any of these markets or something, blacks, you use cards, but they will bring their purse out and pay in cash. What is driving that? What is behind that?
Okay, sir, let me answer that question the way that I know. I went to repair my the remote. So when I got to the place, the guy finished. He now asked me to pay something. I think very low, maybe $30 or $40. He now said, if you have cash, he said pay this exact amount. But if you don't have cash, they will charge me.
Okay. Yeah, tax. That's tax. Yes. I hope that's not.
So
tax
when
savings.
I pay that tax, when I pay that $40, it goes into his own personal pockets.
Oh.
It's not reflecting as a business.
Yeah.
This one is in shops. Maybe you go to, if you start observing, maybe Walmart or something that they don't, they don't. What is driving that? If you start observing, probably you don't observe.
I think I have noticed it too, but I feel it's a particular generation. Have you seen younger folks doing cash? They're probably doing what do you call this type of job? What we call manual jobs. Trade. That's what they probably do. In the cycle of tradesmen, they prefer to do cash. So if that's the field they are in, if they are the younger folks, they must have learned that from the older folks. So they do more of cash because they save money. Just like you said, part of why they do that is they save money. They don't keep money in the banks.
I know whoever cash is not reported. That's what I know. People take advantage. I know farmers do a whole lot of cash. And why? Because farming is one of the most profitable business in this land. Because all they do, they can go and buy equipment for cash, and I can't deny them. But for any other person doing cash, either he's doing his savings on tax, or he doesn't want the transaction to be reported. So
I have a question, sir.
That's what I know about.
I think before my question, I noticed what he said is true. When we go to went to TD Bank one Saturday morning, we saw one Aboriginal. I would say we should not call them Aboriginal, we should call them what? Native, right? So the amount of money was withdrawn on counter. I was like, what is he going to do with this money? They were just packing the money. And he went out with the money cash in his bag. Two of them. So, and of course, then they are older folks, based on what Bra Pumi just said. My question is, now, based on our backgrounds, some of us, what we know is integration by parts. That's all what we know. But we discovered that some of you people now, you know far ahead of us. And doctors too now, that has been here before all of us too. He just know how to make prescription and give injection. We now discover that we need to learn more. But I'm asking, is there any persons or business that can do this kind of review for an individual that want to go into buying property and things like that? Because somebody said something to me not quite long. He said he wanted to buy a property, and he has this valuer. How do they call them? Is it valuers? Realtor. He said they went to inspect the house. Okay. So after they finished, what they gave him was 60 pages of reports on that property. He said he ran away. He said he paid $600, but that $600 saved him a whole life of trouble. So my question is, do we have a body like that? Or if we don't have a body like that, can't we start thinking of having, I'm going to work with you. You can be my principal, but anything you ask me to do, can't we think of having that kind of a body that will help people to know this much? Because when they know this much, they will say so much more, including me.
Also, I don't have a direct answer, but what I think is, information in this land is available and it's very fluid. Very, very fluid. It can be, they will say it in passing. Let me just say in passing, yeah. That if you don't keep your ears to the ground or know what you want to hear or what you are looking for, it will just like you didn't hear it. It will just pass as if like you didn't hear it. And I think, unfortunately, again, within ourselves, within we the black communities or the immigrants, or we the so-called, don't let me say Nigeria, we this side of town, we are not doing well for ourselves. I would say that, unfortunately, because we either don't open up, or we either don't share. And as much as I also would try to understand that's where we are coming from, I know it's the location that has changed, but we can't be here and be so unkind to each other. But either people don't open up, because it's also, I know you can't be a town crier and be shouting around this and that. That might be a problem of sharing information. But also, people also don't get to open up as well. Like for me too, when we wanted to do it, it's RBC that first called me for mortgage in Canada. And it was so good. I was also curious and very excited about somebody even calling me for a mortgage. But the terms and conditions were not good. And unfortunately for the guy, I would have just blindly also walked into it as well, because I was not talking to anybody as well, and I was not even equipped the information I needed. But it was just not, it was our account officer in Saskatoon. I was here in Regina. So he was just calling me maybe once a while randomly, and I was ready to also move fast as well. But it was just not keeping up with me anymore. That was how the transaction broke up. And I was happy I didn't get to sign up with him eventually, because he was giving me like almost 5% or there. We still did 4.75 anyway, but it was giving me almost 5% even at that time, with banks, with RBC's terms and conditions for mortgage. So I think there's no such body, if I may say in one quick answer, but it's just the level at which one open up, and also the caliber of people one talk to. Because as I said, information is very, very fluid here. We just hear it and it was just like in passing. But it's what we do with those information that really matters a whole lot. Like I would say, hardly will I want to do something that I won't try and run with some people that I also look up to, that at least give me one advice. Does it make sense? Does it not make sense? And at least it has saved me a whole lot of mistakes I would have also made. And nobody knows it all. So I think it's just about we speaking up some more, and also being curious to look for information and learn or know one thing or the other more. And as Brother Damola said, you can negotiate anything in this country. Nothing is casting, so you can negotiate. But the moment you sign, then you don't hold the stick anymore. Somebody else calls the shots. Because the moment you sign, that you pay a penalty or you pay something ridiculous. But before you sign, you can make all the decisions you want to. But the moment you put pen to paper, then you are breaking a contract. And a contract is a contract. Thank you, sir. And God bless you.
Thank you, sir. Thank you, sir. On behalf of the men, I want to thank the pastor for giving us this opportunity. This is a follow-up of the conversation we had like 3 Sundays or 2 Sundays ago. Because of time constraint, we couldn't ask questions like this, and we felt that it would be good for us to create a forum like this for us to, ask questions and share ideas and all that. So we appreciate you, bro Shola. Thanks for the time, for the research, for everything. We appreciate you. And the pastors, we thank you for the opportunity, sir. If we ask you and you say no, what will we do? But graciously, you obliged us this venue, and we are appreciative of it. Thank you, everyone, for taking time. At least we have 1 or 2 things to take back home. And we Nigerians, I think what you said about us, we need to be kind of open more. A lot of things, we bottle a lot of things, and I don't know, maybe it's a Nigerian thing, me only, you want to you have an information, instead of you to share it, you hoard the information as if, hoarding that information will make you greater than that person. It doesn't work that way. So I thank you, sir, for sharing, this info. It's really, personally, I when it comes to issue of banking, loans. I think I'm just in class 1 here. Back home, I don't. Anything is, you buy your car cash, you buy everything cash, you buy this thing cash. So for you to go to bank I've never kind of, experienced it. So it's a new environment, and you need to, the way they do, they are doing, but you don't. So I think it's better we kind of, share information. If you think anything that is happening might not even be in the financial world, it can be in anything. You feel that your brother will benefit from this, share it, please. It doesn't take anything away from you, please. Thank you, and God bless you. Broshola, thank you once again. And everybody, thank you, the online. Yes, sir.
Again is we should ask questions. We should just ask questions. Whether foolish or wise, we should just ask questions. In my place of work now, they just said that I see people, they will buy fuel, that's gas. They will dump it into their receipt. They will dump into a place like that, like a box. Nobody knew. Why are they dumping it in that place? Until recently, and I asked question, why are you people throwing this thing there? They said they do raffle draw. That every month you can just be picked and you'll be given like $20 or $50 to go and buy this thing. And some of us, we just buy, you throw it away. And you think, okay, maybe at the end of the year they might give you something, but you can see what they do. So we should ask questions. I didn't even know about sick time before, that you can use it to do anything. Before I left Saskatoon, I took it one day, just one. I didn't even know that I can use it like anyhow I want. That if I'm feeling like I don't feel like, every day I carry myself to work. When I'm happy, every day I just push myself. I didn't even know anything. Just one day. That was the only day I used. And I see. So it's good for us to ask questions. And I see them, they will just say this Friday, they say, they just say they are not coming to work. I'll say, what happened? I would think it's something serious. And I'll see the person on Monday, and I say, what happened? I don't know. I say, wow. So we should ask questions again and again. Whether wise or not wise, we just ask questions. Praise God.
Thank you. Once again. Okay, sir. Yeah, like CNN, we see at the time. You are what you know.
I have a request, sir. Is it possible that the men will have more things like this in year 2026? Because we are tired of just giving us one thing and it takes a while before we have another. There's nothing that says we can have this. I might be amazed that some people are watching online and some people will still watch this. So an avenue for us to break what you told us initially is also for us to have more things like this. Things that are meaningful, things that are relatable to people. And we stick to time. There's nothing that says we can have like maybe breakfast or things like that, or snacks, or but I believe that in 2026 I'm challenging the men. Please, let's have more things like this. That's why we are the men. Let's lead by example. Let's show them how it's to be done. And we have all resources in our midst that we can. And in case we need to bring people, we can. I know this year we brought in one person from PPP. But we are tired of just one dosage for 1 year. We can do better. Thank you, sir. And thanks for this.
Thank you very much, sir.
Yes, sir.
So we will, it's noted, sir. We'll be planning more by 2026. Any other? Thank you very much. And everybody, thank you. God bless you. Thanks.